Okay, let's jump right in. Welcome, everyone, to the Deep Dive. Our mission today is pretty simple. A rapid financial market snapshot. We're looking at December 9th, 2025, specifically around 9:30 a.m. Hong Kong time, to really get to the data points that are, driving things right now.
And what's driving things is this really fascinating dual tension. On one side, you've got these very strong, almost exciting tailwinds from AI and the chip space. But that excitement is immediately clashing with this persistent, I'd say cautious uncertainty coming from the Federal Reserve about what they're doing next.
That tension really is the core story. And if you look at a global risk thermometer like crypto sentiment, it's still squarely in that fear-conscious zone, which tells you risk appetite is limited, even if some stocks are rallying on specific news. So let's start where we always do, with the macro environment and the liquidity pulse check.
Right. So when we dive into the fixed income world, we find a story of, let's call it, careful divergence. The benchmark 10-year U.S. Treasury yield is sitting right around 4.16%. Now, that's a modest uptick recently, so it suggests, slight inflationary or growth expectations are creeping back in.
And what about the short end of the curve? Because that's where the market really shows its hand about the Fed. Right?
Exactly. The short end is so much more sensitive. The 2-year U.S. Treasury is at approximately 3.56%. It's a little elevated compared to a few weeks ago, and that directly reflects the market's ongoing nervousness. For you, the key thing to watch is the relationship between those two numbers.
The spread. So the 10-year minus the 2-year. What's that telling us about what's coming?
The spread is either still slightly positive or nearly flat. It really depends on the tick. It's not deeply inverted, which is good, but its flatness tells us the market is just profoundly divided. You see, a deeply inverted curve usually screams recession, but this uneasy flat curve, it just signals two warring camps. One side is betting the Fed will have to ease aggressively, while the other thinks they'll need to stay higher for longer. There's just no consensus.
Which leads right into that policy focus. The Fed keeps saying they're data-driven, but what data specifically is stopping them from taking a victory lap?
It's the stickiness. While the big inflation numbers have eased, it's the resilience in the labor market and in service prices that's the red flag. Wage growth is still stubborn, and service costs keep climbing. So this week, all the focus is going to be on the scheduled Fed speeches. Every single word will be scrutinized.
Okay, let's zoom out a bit. Global liquidity. What's the U.S. dollar index, the DXY, telling us?
The DXY is holding steady around 99.0. It's a neutral to moderately strong position. And for you, trading risk assets, a strong dollar is a constraint. It just makes everything more expensive for international investors. But what's really fascinating is the liquidity check you can do with the reverse repo facility, the RRP.
RRP is one of those acronyms that's super important, but a bit opaque. What does low usage actually mean for the average person listening?
It's a great sign, actually. RRP usage is extremely low right now, like between 1.7 and 2.2 billion. Basically, that's where big institutions park cash overnight with the Fed. When usage is high, that cash is trapped. Low usage, like we see now, suggests liquidity is normalizing. That money is back in the private banking system. Structurally, that's very good news, even if we still have that typical year-end thinness in trading.
Okay, so a foundation of normalizing liquidity, but deep division over rates. Given that, let's see where the money's actually flowing. And this is where it gets really interesting, because the dominant narrative in U.S. equities is almost purely event-driven, all about AI and chips.
And that narrative has a very clear focus stock. NVIDIA, of course, it's the poster child. It's trading in roughly the $180 to $186 range, and it is just ridiculously sensitive to any news in that space.
And our sources flagged one very specific piece of news that's really setting the tone for today.
That's right. It's the potential U.S. decision to allow the export of a specific high-end chip, the NVIDIA H200, to China. Now, it would be with new fees attached, but if that gets confirmed, it's a huge revenue boost. China's a massive market, and any easing of that semiconductor tension just provides this huge short-term lift to sentiment, not just for NVIDIA, for the whole supply chain.
And you can see that focus momentum in the broader indexes, but there's a telling difference. VOO, the S&P 500 ETF, is closing between, say, $628 and $630.
Solid, but QQQM, the Nasdaq Q100 ETF, is in a tighter range, around $256 to $258.
The QQQM number really tells the story. It's just so much more influenced by the swings in these huge tech stocks, like NVIDIA. When NVDA jumps 2% on a rumor, QQQM feels it immediately. It just confirms that the market gains are being driven by a very narrow slice of tech enthusiasm. All right, let's pivot from equities to the other major speculative asset, crypto. Bitcoin, it's stable, holding that tight 89K to 91K range. But stable isn't the same as safe, is it?
Not at all. Far from it. Bitcoin right now is like a supercar on an icy road. It's holding steady near $90, but the underlying liquidity is exceptionally thin. So even within that tight range, BTC is prone to these violent, sudden moves. Any macro shock or one big trade can send it flying.
And what about Ethereum? It usually follows Bitcoin, but it has its own fundamentals too.
ETH is holding around the $3,100 level. It definitely tracks BTC and ETF sentiment, but ETH also relies heavily on its own on-chain activity. And we are seeing continued strong fundamental usage on the chain, which kind of provides a price floor alongside all that macro sentiment.
Speaking of that, we had a hot topic in the crypto finance space today that adds another layer of institutional exposure.
That's the planned listing of 21 Capital. It's a Bitcoin-related entity, and it's expected to list on the NYSE today under the ticker XXI. And this isn't just another listing. It gives more institutional visibility and a dedicated, publicly traded way to get into the crypto finance sector. It's another sign of traditional finance adapting.
Okay, so you've got a divided bond market, normalizing liquidity, AI-fueled stock momentum, and cautious, thin crypto markets. How do you put that all together for a strategic view?
You have to look at volatility. The VIX, the classic fear index, is pretty low. It's hovering between 15 and 16. What's fascinating is that a low VIX suggests complacency. It says the general market risk appetite is still there. We're not in a panic.
But wait, hang on. If the VIX is low, suggesting calm, how do you square that with crypto screaming fear?
That's the synthesis you have to make. The Crypto Fear and Greed Index confirms that digital asset skepticism. It's firmly in that fear-cautious zone. And this dichotomy tells you that traditional equity investors feel comfortable riding the AI wave. They see that risk as manageable. But when it comes to purely speculative assets like crypto, risk preference is clearly limited. The money is only focused on proven narratives like AI monetization, not pure speculation.
That distinction is so important. So, bringing it all together, this market driven by AI good news and Fed uncertainty, what's the definitive tactical summary for today?
The advice is really, it's about focus. Focus on event-driven trading, but couple that with extremely rigorous risk management. You just have to respect the thinness of this market.
And if we dig into the sources for some concrete actions, what are the key tactical recommendations?
First, on the event-driven side, it makes sense to track NVDA, the semiconductor supply chain, and related AI ETFs. Especially when concrete news, like that H200 export confirmation, might drop. But, and this is a big, the necessity of having hard stop losses set beforehand cannot be overstated. Momentum can reverse in an instant.
And the second recommendation goes back to that anchor we started with, liquidity.
Absolutely. You should maintain a liquidity buffer. Retain cash or stablecoin positions. With thin UN liquidity, cross-market risks are higher. That buffer lets you capitalize on sudden dips without being forced to sell something else at a loss. It's your hedge against this volatility.
That makes perfect sense. Balance the AI excitement with caution everywhere else. Now, beyond the big listed assets, our sources flag high expectations for assets you can't easily buy yet.
Right, this is where we get into the high-risk, high-reward zone. Unlisted assets like Anthropic, xAI, and OpenAI, which are traded through private mechanisms, sometimes called pre-stocks. Expectations for these are just through the roof because they're so central to the AI race. I mean, Anthropic just launched Claude Code on Slack, which signals a huge jump in its enterprise value.
So they offer this huge potential, a high beta, but they come with a massive asterisk. Can you quickly explain what pre-stocks are and why they're so risky?
Sure. Pre-stocks are basically shares in private companies that are traded before an IPO, often on specialized platforms. They offer huge potential, but the risk comes from three things. First, compliance and regulatory uncertainty are just enormous. Second, valuation is subjective and incredibly volatile. And third, and this is critical, they are illiquid. It's very hard to sell them when you need to.
And that leads us to our final provocative thought for everyone listening. While the headlines are on NVIDIA, the market is signaling that the highest potential growth might be in these unlisted unicorns.
That's exactly it. So the true deep dive for you, the listener, should be researching how to balance that excitement, that high beta potential of an Anthropic or xAI, with the extreme scrutiny these assets require. You have to focus on risk exposure, on contract legitimacy, and on your exit strategy before you even think about chasing the private market AI hype.